Thanks everyone that's come along this morning. In the interest of time, we might jump into this. I'll let you know that copy of this presentation will be available afterwards. We are recording it today. And you do have the opportunity to ask questions, ask in the Q&A function at the bottom of the Zoom, and we'll try and answer as many of those as we can at the end. But let's get into it. So thanks for coming today to the Victoria Market Update and Outlook. What I'm going to do is I'm going to start with a bit of a national economic overview to set the scene of what we're seeing at the moment, and then we'll delve into what's happening in the Victoria housing market. But to start with, let's have a look at economic growth. So economic growth at the moment is particularly weak. You can see there that over the past year, the economy's only grown by 1.1%. Which is outside of the pandemic, the weakest rate of economic growth since March 1992. That dotted line there you can see is the 30-year average. So over the last 30 years, economic growth has averaged 3.1%. On a per capita basis, economic growth fell by 1.3% over the past year. So one of the key things driving the overall expansion of the economy is how quickly the population has been growing, and that's adding to overall demand in the economy. So the economy is certainly weak at the moment. And we can also see that households are responding to this weakness by saving a lot less. So the household saving ratio has fallen to 0.9%. You can see how high it was during the pandemic when people really didn't have many options as to how to spend their money. But it's well below that 30-year average. And again, you'd have to go back to before the global financial crisis to see the household saving ratio as low as it is at the moment. On the right there, you can see household consumption. So household consumption, which is spending, it makes up about 50% of overall economic growth. And again, like broader GDP, it's well below its long-term average at 1.3% growth over the past year, compared to a long-term average of 3.2%. So both of these sets of charts really highlight that the economy is very weak at the moment. Why is it so weak? Because inflation has been so strong. And as inflation has increased, we've lifted interest rates, and that's discouraged people from spending as much as they were in the past. On a quarterly basis in March, inflation, both headline and underlying takes out some of the more volatile items, was 1% over the quarter, which was stronger than what was anticipated. Now, on an annual basis, inflation continues to trend lower, 4% for underlying inflation, 3.6% for headline inflation, but it's still outside of the Reserve Bank's target range of 2 to 3%. And as long as inflation remains above that target range, there's going to be a risk that we do get further interest rate increases. It's certainly not our expectation that is going to happen, but it is a risk while we have this heightened level of inflation. And the next quarterly read of inflation for the June quarter will be a very important one. If it comes in stronger than anticipated, then we could actually see the Reserve Bank lift interest rates again. So I think most people are hoping that we don't see that. Now, at the moment, the Reserve Bank isn't forecasting inflation to come back into the target range of 2 to 3%, which is shown in the grey there, until late 2025. So even though we're close, the expectation is actually getting it to dip below 3% is going to be a challenge. And one of the reasons why that is a challenge is there's still a lot of things where we're seeing quite strong escalation in inflation. Namely, you can see there, services inflation is much stronger. And when we think about services and that inflation where it's particularly strong, you can see insurance. Now, you don't have to pay insurance, but it's best practice to do that. You can see education inflation is really strong. Now, HEX, for example, is indexed to CPI. So we've had high inflation, so education costs have gone up. But also, the huge volume of international students coming in is driving up the overall cost of education. Transport costs, a lot of those are indexed to inflation. Housing costs, we're seeing a slowdown in the increase in new housing costs, but the deficiency of rental stock is seeing housing costs overall continuing to climb at a fairly rapid rate. And you can also see alcohol and tobacco. And again, excise on those products is indexed to inflation. So while we've got high inflation, the cost of alcohol and tobacco will continue to rise at a fast pace. So we lifted interest rates to try and stem inflation, and that's working to some degree at the moment. Now, the cash rate is 4.35%. It's been on hold since November of last year. My base case is that it's going to remain on hold, but there certainly is a risk that we could see another hike if inflation doesn't come down in line with the Reserve Bank's forecasts. At this stage, though, the expectations are there's not going to be an interest rate cut until the middle of 2025. Now, go back 3 or 4 months ago, a lot of people were expecting interest rate cuts, maybe even as early as September this year. So that's pushed expectations out quite a long way. And it's going to be interesting to see how households respond to this, because I think a lot of people were buying and selling property thinking that there is going to be that interest rate relief late this year, and it looks very unlikely that that's now going to happen. The labour market has probably been the strongest segment of the economy over the last couple of years. So the unemployment rate at the moment is 4%. You can see the long-term average over the last 30 years is an unemployment rate of 5.9%. Until 2 years ago, we hadn't had an unemployment rate below 5% since before 2008. So the labour market is really tight, really strong. You can see employment participation rates are pretty much at record high levels. And you can see that job creation, whilst it has slowed, it's still quite strong, 2.5% growth in the number of people employed over the past year. The 30-year average is 2.1%. But what we are starting to find, though, is there's more job creation in the part-time segment as opposed to the full-time segment. So some signs of a weakening labour market. You can see the unemployment rate has trended up from 3.5%, where it was at its low about 12 months ago now. And you can also see that the underemployment and underutilization rates are trending higher, but again, are well below their long-term average. So underemployment measures the number of people that are working, but not getting as many hours as they'd like. So that could be just simply someone part-time that wants to be full-time, or that could be someone that's part-time, say 20 hours a week that wants to be 30 hours a week. Underutilization is the combination of unemployment and underemployment. What we have seen, though, is a big slowdown in the number of hours worked. It's increased by just 0.6% over the past year. 12 months ago, it was up about 5% over the past years. So again, some signs that the labour market is weakening, and we do expect that the unemployment rate is going to drift a little bit higher over the coming months. We're also seeing some of that weakness when we look at the number of online job advertisements. You can see that they're down 21% from their peak. They're down 15% from where they were a year ago. They're still very high on a historic basis, but they are trending lower. And you can see that Victoria has seen the biggest decline in the number of online job advertisements over the past year, down almost 21% over that period of time. Now, the tight labour market has seen wages increase, but we can see the annual rate of wage growth has actually slowed from 4.2% at the end of last year to 4.1% in March. Still very high on a historic basis. You have to go back to 2009 to see wages growing this fast. The good news, though, is at 4.1%, wage growth is stronger than inflation, which is at 3.6%. So for the first time in about 3 years, households are getting real wage increases. So they're not going to feel like they're falling as far behind as they have been when we saw inflation take off, but wages not take off at the same pace. Again, we've probably seen wage growth peak and it will fall from here, but it's probably not going to fall as rapidly as inflation, which means those real wage increases will continue. Moving to the lending environment, so new lending's up 24.5% over the past year, while refinancing is down 16.3%. Refinancing has slowed because interest rates aren't changing as often, and most of the people that were on fixed rate mortgages rolled off early last year. If we have a look at the components on the right there, you can see that subsequent buyer lending is the largest. But subsequent buyer lending's up 18.8% over the past year. New lending to owner-occupier first home buyers is up 18.5% over the past year. And lending to investors is up 36%. So it's seen the strongest rebound. I'm talking to people from Victoria, though. That's not the case in Victoria, and I'll touch on that in a minute when we delve into some of the economic data for Victoria. We've also seen really strong growth in housing construction costs over the last few years. And what this is resulting in is a big premium for brand new homes over existing homes. So a lot of buyers are preferencing purchasing an existing home just because that price gap, they find it hard to justify. We have seen a slowing of this increase. So over the past year, material costs were unchanged over the quarter, and they're up 4.4% year on year. But that's the slowest annual growth in for quite some time. But what we're starting to find, though, is that there's the output costs, which is the actual building and the wages that go into construction. They're starting to escalate again. So you can see that the annual rate of growth has ticked a little bit higher. What you'll also notice is material costs don't tend to come down. Yes, they've gone up a lot. What's likely to happen is they're not likely to grow as much as they have in the past, but there's been very few instances where those input costs, which are all of those materials shown on the right there, very few instances where they've actually fallen. So for developers, what they really need is existing home prices to rise so that the differential between new and existing homes narrows. At the same time, we need to be building a lot more housing, and unfortunately, we're not doing that. So dwelling approvals are continuing to trend lower. They're pretty much at the lowest level they've been in a decade on a 12-month average level. Why are we not building anymore? There's a number of reasons for why. Firstly, interest rates are the highest they've been in 12 years. That means there's fewer buyers for brand new properties. There's fewer buyers for all properties, but part of that is also that interest rates, because interest rates are so high, it's very difficult for developers to get the level of pre-sales they need to go ahead and commence construction. You've also got higher interest rates mean higher developer costs, higher the developer financing, higher construction financing costs, and you've also got planning delays and things like this which are playing into it. So it's almost like a perfect storm. Right at the time that we need more housing, it's very difficult for developers to deliver that additional housing we need. You can also see that playing out with commencements. So there's not many commencements happening at the moment. There's still a lot of housing under construction. The main reason for that is a lot of this was started way back in the pandemic and has been delayed. And basically, as soon as you turn sod on a site, it's considered to be under construction. So there's still a lot being built, but that pipeline of new construction behind has really thinned out quite significantly. At the same time, though, we need to be building more because the population of Australia has increased dramatically over the past 12 months. It's up 2.5% over the year. That's about 650,000 additional people in Australia. And it's all being driven by net overseas migration. Natural increases over the last 12 months was actually the lowest it's ever been. You can see that net overseas migration has likely peaked, but it's still very high on a historic basis. Who's driving the migration? Overwhelmingly, it's temporary students coming into the country. So if you're here temporarily, at least initially, you're probably not going to be buying a home. You're going to be renting a property. And this is why the rental market is so challenged at the moment. Looking quickly at some of the same data we've just looked at for Victoria specifically, the unemployment rate is higher in Victoria at 4.4%. Like we're seeing nationally, it's trending higher. The annual change in the number of people employed is actually stronger at 3% over the past year. If we have a look at where the jobs are being created, you can see that hours work is actually slightly weaker over the past year than it has been nationally. And you can see that the underemployment and underutilisation rates are somewhat higher in Victoria. If we look at lending, now you remember that I said nationally investor lending was up 36%, and this is the value of investor lending. In Victoria, it's only up 16%. So investor lending in Victoria is really lagging behind quite significantly. I think we know the reason why. The Victorian government has decided to tax investors a lot more, and that's seeing people sell out of the market, but it's also seeing fewer investors coming into the market because they're choosing to go to other states where conditions are much more favourable. Subsequent buyer lending's up about 16%. That's slightly less than what we're seeing at a national level. And first home buyer lending is up 21.5%, which is a little bit more than what we're seeing nationally. And I think it speaks to the fact that price growth in Melbourne and Victoria has not been as strong as what we've seen in a lot of other parts of the country. So first home buyers feel like they can actually get into the market at the moment. In terms of dwelling approvals in Victoria specifically, they're well down on their recent highs, both for houses and for apartments. Again, it's just difficult to get the level of pre-sales you need to go ahead and start constructing new housing. And you're also seeing that play out with commencements, but there is still a lot of housing under construction at the moment. And if we look at the population growth stats for Victoria, you can see that net overseas migration into Victoria remains extremely high. It did come back a little bit over the quarter, but you're adding about 40,000, 45,000 people a quarter at the moment. Net interstate migration is still negative. Now, obviously, during the pandemic, you can understand why people were reluctant to move to Victoria and why a lot of Victorians wanted to leave. But I think over the next few quarters, we'll start to see that go positive again. And I think one of the main reasons is, relatively speaking, housing in Victoria is looking quite affordable. And relatively speaking, rents are looking quite affordable in Victoria as well. So I think that will drive more people that feel like they need to migrate, probably either to New South Wales or Victoria, will choose Victoria because it feels like they might actually have a chance to own a property in the state. So if we look at the economy over the coming year and where we think things are going to be, on the right is the forecast table from the Reserve Bank as to what they think things are going to look like over the next few years. So the first half of this year, we haven't got all of the data for that yet, but we expect the economy to be continually weak early this year. Then we do think that there's going to be a rebound over the second half of this year, and that's because inflation is going to fade. Interest rates potentially haven't moved for 9 months, but also tax cuts are coming in just over a month's time, and that's going to give people more money in their pocket, and we'll probably start seeing households consuming somewhat more. Inflation, as I talked about, we're expecting it's going to remain outside of the target range, but it is going to moderate a little bit further over the remainder of this year. I think interest rates, the likelihood of a cut this year is extremely low now, and we're looking at interest rates being on hold into next year. I would probably say, February, March is looking most likely for interest rate cuts where we are now next year. The labour market, we expect that to continue to weaken, unemployment to drift a bit higher. Some of the labour shortages will continue to wane. And as the economy is slow, businesses will likely slow down their hiring. Wage growth, as I said, has peaked, but we think that wages will continue to rise at a faster pace than inflation, giving households real wage increases. New housing construction, unfortunately, looks like it's going to be even lower this year than it was last year. And of course, the federal government wants from July of this year to start delivering on the 1.2 million new homes over the next 5 financial years, which I think has got very little likelihood of being delivered. And certainly for the first couple of years, we're going to be well below that run rate we need to achieve that. And I think population growth, as I said, we're already seeing some early signs that things are slowing, but it's going to remain well above long-term average levels, which means even though we're building a lot less housing, we need a lot more housing because the population is expanding. Let's move on to what's happening in the established homes market. So here in Melbourne, you can see prices have increased over the last 3 months by just 0.3%. In regional Victoria, they're down 1%. Now, the best performing regions of Melbourne, which are in the black on the bottom on the right, have been the northeast and has been the Mornington Peninsula. You can see the inner south and the western suburbs have seen prices fall. Regionally, very mixed. You can see increases in Bendigo in the northwest and Warrnambool, but falls over the last quarter elsewhere. If we look over the last 12 months, prices regionally have fallen. Prices in Melbourne are only up 0.9%. Now, to give you some context, over the last 12 months, prices in Perth are up 20%. Prices in Adelaide and Brisbane are up about 14%. Prices in Sydney are up about 8%. So Melbourne has lagged behind significantly those other major capital cities in terms of price growth. And we'll get into why that's happened. If we look over the past year, splitting out houses and units, so house prices are up 1%, unit prices are up 0.2% in Melbourne. In regional Victoria, we've seen a decline in house prices and a marginal increase in unit prices. The standouts in some of these, you can see that the Outer East unit prices are up 3.9%. You can see Southeast house prices are up 2.7%. You can see Northwest house prices are up 4.3%. A very mixed bag throughout the state, but generally speaking, pretty slow levels of growth. Now, if we look over the last 5 and 10 years, so over the past 5 years, we've seen prices rise 26% in Melbourne, and we've seen them rise 66% in regional Victoria. And if we look over the last 10 years, a 48% increase in prices in Melbourne, a 90% rise in regional Victoria. Again, if you're going to places like Brisbane and Perth and Adelaide, you're looking at about a 55, 60% increase in prices over that last 5 years. In Sydney, you're looking at about 45%. So Melbourne has really lagged behind in price growth. Regionally, prices have risen pretty much aligned with what we're seeing in most other regional parts of the country over that period of time. The slowdown in price growth in regional Victoria over the last year or so has been much more significant than what we've seen in other regional markets around the country, though. Now, looking at the price premium for houses versus units, not surprisingly, inner city areas have got the highest prices and the biggest premium for house prices over unit prices. And I think this really speaks to the fact that we need to start delivering more medium density in established suburbs, because quite simply, people can't afford to live in these areas, and these areas are really well located, have really great amenity, and more people need to benefit from being able to live in those markets. Moving on to listings, and one of the reasons why price growth in Melbourne has been so much weaker than most other capital cities is that there's a lot more stock for sale. So you can see here that the number of new listings in May this year was up 36% compared to a year ago, and it's 34.5% higher than it has been on average in May between 2018 and 2022. And you can see through the start of this year, new listing volumes have been very strong right throughout Melbourne, and it's a similar story across broader Victoria as well. So a lot more people are bringing their properties to the market. There's also, just even before there was more new listings, there was, relatively speaking, a lot more stock for sale anyway. So total listings are up almost 25% from where they were a year ago, and they're up 26% from that 5-year average. Have a look at Ballarat, for example. There's 100% more stock on the market now than there was on average in May between 2018 and 2022. There's 76% more in Geelong. There's 47.5% more properties on the market in Melbourne's West. So people don't have that same level of fear of missing out in Melbourne as they do particularly in markets like Perth, Adelaide, and Brisbane, where stock levels are extremely low. So there's just more choice for buyers in Melbourne than what we're seeing in other parts of the country and across regional Victoria too. Even though there's more stock, though, sales volumes have been quite strong. So you can see, compared to May last year, the number of sales in May this year was up 18%, and it was up right across Melbourne and most of regional Victoria as well, with Bendigo and the Northwest the exception. So even though there's more stock, there are more buyers out there. So the level of demand in the market is still reasonably strong when we look at these figures, but there's not enough sales, people buying at the moment, to offset how many more people are looking to sell at the moment. So I guess for someone looking to buy, it's a good opportunity to potentially negotiate yourself a really good price. Moving to measures of levels of demand. So the way we look at demand is looking at inquiry per listing. Now, in Victoria, you have the statement of information, which you don't have in other states. So relatively speaking, inquiry per listing is lower in Victoria than it is elsewhere. And you can see that in both Melbourne and in regional Victoria, it's fallen relative to 12 months ago. The level of inquiry now is pretty similar to what it was before the pandemic. May not surprise you that people don't always want to talk to real estate agents. So if they don't need to inquire, they potentially won't, and they'll just show up to the open for inspection. But we are seeing a little bit less inquiry per listing. Now, this is made up of the volume of inquiry plus the number of listings. And remember, listings are up 20% from where they were a year ago as well. So inquiry is probably fairly flat. It's just that there's more stock on the market. But properties are still selling pretty quickly. So the median days on site in Melbourne at the moment is 30 days. A year ago, it was 32 days. And if we look at that 5-year average to 2022, it was 37 days. So if people are realistic on price or adjust their price to meet the market, a lot of properties are still selling. What we are seeing, though, is that there is a mounting number of properties that have been on the market for more than 2 months. We find that about 80% of all properties that sell are properties that have been on the market for less than 2 months. So if you can't get that property sold quickly, then you run the risk of that lingering on the market for a very long period of time. So where do we think the market's going to go over the next year? So I think more broadly speaking, if we look at the housing market over recent decades, we've had really strong price growth, and Melbourne's probably been the epicenter of this. And there's been a few things that have really driven it. We've seen interest rates fall from 18% at the start of the 90s to basically nothing. As interest rates have fallen, people have been able to borrow a lot more money. That's bid up property prices. Credit availability, it's easier to get finance now than it was in the 80s, but it's actually quite a bit more difficult than it was through the 2000s. And ever since the GFC, some of that credit loosening that happened through the 90s and 2000s has been tightened. If you have a think about, you go and try and get a mortgage, the banks need to know, how much do you spend eating out? How often do you travel? Are you planning to have kids? Private school fees? You never used to get asked those questions. And I don't think that's going away, unfortunately. You've also got the banking regulator, APRA, who's come in and introduced, changed serviceability buffers. They've introduced things like credit growth caps for interest only and investor lending. And again, I don't think that's going to go away. And that's going to mean that credit's certainly not as hard to get as it was in the 80s, but it is harder than it was 15 years ago to access finance. The other big thing that's changed is employment participation has increased dramatically. And that was in one of the labour market charts earlier, pretty much at record high levels. A lot of this has been driven by more women joining the workforce. And as more women have joined the workforce, household incomes have increased. And as household incomes have increased, people have been able to borrow more money and have been able to, purchase more properties and spend higher prices on properties. Again, we're probably close to the peak of employment participation. We're certainly not going to get as many women joining the workforce over the next 20 or 30 years as we have over the previous 20 or 30 years. The one thing that is still really strong, and it's probably starting to become a little bit more contentious, though, is the rate of migration. And obviously, migration at the moment is largely driving demand for rental accommodation, but longer term, as people decide to stay here, it drives demand for housing. So if you think of at least 3 of those 4 factors are unlikely to be as strong going forward. Now, that doesn't mean prices won't rise, but what it does mean is we probably can't expect prices to rise as quickly as they have in the past. I mean, 15 years ago, everyone would tell you property prices double every 7 years. Then it became every 7 to 10 years. Now it's more like every 15 years. So that rate of price appreciation is probably going to slow going forward from here. If we have a look at the housing market right now, though, the demand for housing is surprisingly strong when you consider how high interest rates have increased, how much borrowing capacities have fallen, and also just the fact that we're very late in this cycle. We've been seeing quite strong price growth at a national level, not necessarily in Victoria, since the pandemic. Even though we've seen the volume of stock for sale increase, we have in most parts of the country seen a bit of an acceleration in price growth. And we think that price rises this year could be stronger than those last year. We were anticipating price growth of 1 to 4% in Melbourne this year. I still think it's probably going to be in that range, but depending on how much the increase, the reduction in income tax plays a part, and how much that drives demand for housing, it could actually be on the higher end of that 1 to 4% forecast. Although, with more stock on the market, that means there is more competition and there's less fear of missing out. So vendors really need to be realistic on price, because buyers can be a lot more selective in this market at the moment. The high cost of new housing is likely to see people continue to preference existing homes. The high cost of renovation is likely to see people desire homes that aren't in need of renovation. As I said, one of the things when I talk to property developers is say the best thing you can have is stronger price growth in the established market and fewer properties in the established market available for sale, because that will narrow the price differential between your product and existing product. Now in Melbourne, that's not really happening, but in Perth, where prices are up 20% over the past year, that gap has narrowed quite significantly. So I think, again, that's going to see people continue to preference existing homes in Victoria as opposed to brand new homes. Touched on it earlier, but we need more infill housing but there are a lot of political and financial hurdles. I think planning generally gets the blame for why we haven't got more infill housing, but the reality is new housing doesn't get developed unless you've got someone that's willing to put down money and commit to it before the project starts, and we just don't have enough people doing that at the moment. And I think the high cost of renting, which we'll touch on in a minute, is likely to see more people want to become first home buyers, exit the rental market because it's such a tough market at the moment, and get into their own home. So we'll have a look at the rental market now. So over the last 3 months, house rents in Melbourne were up 1.8%, unit rents were unchanged. And you can see across Victoria how much the changes happened over that period of time. $850 a week in the inner south, that's the most expensive market in the state at the moment. Now, if we have a look at the cost of renting in Melbourne, it's up 14% over the past year. It's up 4.7% in regional Victoria. Now, $570 a week is obviously a big increase from the $400 a week it was sort of 2.5 years ago. But rents in Melbourne are actually still quite cheap. The median rent in Adelaide is $550 a week. In Perth, it's $620 a week. In Brisbane, it's $610 a week. In Sydney, it's $700 a week. So relative to those other major capital cities, renting in Melbourne is actually relatively cheap. What's interesting in Melbourne is where we're seeing the strongest rental growth. I think intuitively you would go, oh, the strongest rental growth is probably in the inner suburbs. It's not the case. You can see the southeast, the northwest, and the northeast are the markets where we're seeing the biggest increase in rents. Why is that? I think what we're seeing is that people are having to sacrifice on location, and whilst they probably want to be in those inner south, inner east, or inner suburbs, they can't afford them. So they're moving to a less desirable location in places like the southeast, the northwest, or the northeast. And you'll see this as a bit of a trend as we go through this data. In terms of houses versus units, so house rents in Melbourne were up 12.5%, unit rents were up 10%, and then regionally, we can see that house rents have only increased by 2.2%, but unit rents are up 8.6%. So again, look at the southeast. Unit rents in the southeast of Melbourne are up 22.2% over the last 12 months. Unit rents in Melbourne's western suburbs are up 15%. The northeast are up 15%. The inner suburbs, rental growth has actually been somewhat more moderate, 9.1% for units, 6.7% for houses over that period of time. And then if we look over the last 5 and 10 years, so over the past 5 years, we've seen rents in Melbourne up 35.7%. Pretty much all of the growth over the past decade in rents has happened in the last 5 years. Over the last 10 years, rents are only up 36.5%. In regional Victoria, similar, although rental growth has been stronger, 54.1% increase over the past 5 years, 60.7% over the past decade. Now, if we have a look at rental returns, so we talked about the fact that the Victorian government has decided to tax investors more, which is really disappointing because have a look at the solid red line there, which is the gross rental yield for units in Melbourne, 5.1% rental yield. If we weren't punishing investors, you would probably see a lot more people investing in units, particularly in inner city areas of Melbourne, because of those rental returns. That's the highest rental yield in about 15 years for a unit in Melbourne, and it's continuing to swing higher. Same with houses. Rental yields in Melbourne, you'd have to go back to 2016 to see rental returns for houses higher than they are at the moment. But unfortunately, the fact that the government is punishing investors is seeing fewer investors coming into the market than what we're seeing in other states and territories. if we look at rental stock, it is pretty dire out there. There's been a slight uptick in new rental listings compared to a year ago, but they're well down on their 5-year average. But probably more telling is when you have a look at total rental listings. So they're lower than they were a year ago, and they're 27.5% lower than they have been on average in May between 2018 and 2022. You can see 34.5% fewer rental listings in the inner suburbs, 30% fewer in the inner east, 34% fewer in the inner south. And most regions are seeing fewer rental listings than we saw 12 months ago. But we have seen a little bit of a slowdown in inquiry because we have got fewer listings, but rental inquiry per listing is down from a year ago, 14% lower in Melbourne. It's up 11.8% in regional Victoria. But again, have a look. The southeast is the market where we're seeing the highest number of inquiries per listing, 40.4%. Then the outer east, 37.5%. Then you go to Melbourne's western suburbs, 29.2%. Again, not areas where you would intuitively think that most people are wanting to rent, but the cost of renting in some of those more desirable locations, I think, is forcing people out to these areas. Even though inquiry per listing is lower than it was a year ago, have a look at what things were like before the pandemic. You were looking at about 12 inquiries per listing. So the level of demand out there is more than double what was normal before the pandemic, which just speaks to how tight this rental market is at the moment. And the tightness of the rental market can also be seen here, where the rental vacancy rate, seasonally, it does dip up a little bit at this time of year, is 1.3%, still very low. And you can see, the outer east, a vacancy rate of 0.6%. Northwest, regional Victoria, 0.7%, Hume, 0.9%. Very tight rental market conditions right across the board. And then if we look at the median days on site, 20 days, it's unchanged from a year ago. If you look on average over the last 5 years, you were looking at 27 days as the median days on site. So things are leasing very quickly in most parts of the city at the moment. So where do we think the rental market's going from here? There's a number of factors that are driving rental growth at the moment. Household sizes reduced significantly during the pandemic. They're starting to increase a little bit again over the last year or so, but that has actually flattened out. With fewer people per household, you need more households. So that's driving up the cost of renting. The low level of new housing construction. If you go back 10 years ago, there was a lot of new housing being built, but also a lot of what was being built was being sold to investors. So you were adding to that stock consistently. Now we're not seeing a lot of new construction, but a lot of what is being built for owner-occupiers. So you're not getting that addition of rental stock. And then at the same time, population growth is obviously very strong, and most of it coming from migration, which is driving demand for rental properties. Over the last year, though, we've seen rents rise rapidly. Increasingly, though, the capacity to pay for that rental stock is becoming an issue. So rental growth, even though it was up 14% in Melbourne over the past 12 months, that was lower than the previous year. And we think that in some instances, people just aren't going to be able to pay the rent that the landlord is seeking. And how do people respond to that? People will choose to rent in less ideal locations. People will go into smaller properties. So if they're in a house, they go into a unit. They're in a unit, they might go into share housing. And we're seeing a big increase in share housing at the moment, probably not through want, but more out of necessity, that people are having to go back into that style of living because they simply can't afford rents by themselves. How do we address the problem? So on the supply side, we need to build more housing, but that takes time. And even if we fixed everything at the moment that was making it difficult to deliver new housing, it would still take 3-4 years for that housing to actually be built. So what we really need to do, the quickest way to address this from the supply side, is to get more people investing in residential property. But of course, the Victorian government has made it less attractive for people to invest in residential property. On the demand side, what can you do? You can lower the rates of migration. The government's talking about trying to do that. Whether it's successful or not remains to be seen. You can increase rental assistance, which has happened each of the last 2 budgets, but keep going. Or the other one is encourage more people to become first home buyers. And we are seeing more first home buyers. But if you can give them assistance to do that, obviously a lot of that will free up rental accommodation as well. And I think what we will see over the next year is more investors coming into the market, probably not as many as we would have otherwise in Victoria. And also we're going to see more renters looking to exit and purchase because of the state of the rental market. So overall, that's where we're looking at in Victoria, both from prices and from rents. In terms of sort of longer term for Melbourne and in Victoria, I wanted to talk about that. I actually think when we look at the price relativity of Melbourne to other capital cities, Melbourne housing in particular is starting to look really affordable. The problem at the moment is that there's so much stock available for sale, and that's limiting price growth. So if we can actually get a moderation in the supply of stock for sale, I think once interest rates start to fall, and once we see that net interstate migration into Victoria picking up again, that we could see a strong upswing in prices over the next 2 to 3 years in Melbourne, just because of that relative affordability that is so strong, particularly compared to Sydney, but also compared to places like Brisbane and Perth at the moment. So I don't think it's all doom and gloom for Melbourne. Obviously, the market's a bit tougher than what we're seeing elsewhere at the moment, but I think further down the track there are some bright signs there. So what I'm going to do now, I'm going to stop sharing my screen, and I'm going to have a look at some of the Q&A questions, and we'll see if we can answer those. And we've also got if you could just share your opinion here on how valuable you found this webinar, and then we'll jump into the questions. So an anonymous attendee asked, are rentals included in CPI? Rents are included in CPI. They're the second largest component of the housing component of CPI. So rents are certainly captured in CPI. What's different with CPI rents as opposed to the rents we report? We're reporting advertised rents. The CPI data actually measures all rents. So it's existing rents and brand new rents. There's nothing else in the Q&A, but I'll have a look at the chat. So we've got a question here from with Vic, from Daniel Burmas. With Vic tinkering with taxes on investment, do you think other states will follow or continue to sit back and just watch? Well, New South Wales has just announced that they were going to increase taxes on investors who have properties with an unimproved capital value of over 1.1 million. Which will impact on investment, but it won't be as impactful as those in Victoria. Queensland tried to go down a similar path, but the industry came out very strongly against it, and the state government backed down from those changes. I've got a question here also from Jacob. Thank you for an informative presentation. I'm glad you enjoyed it. There were seemingly two paradoxes that I would like to hear you unpack a bit further. At a macro level, both household saving and spending are down. What is our path out of the wilderness, assuming that it has to come from either public investment or productivity increases? Yeah, it's a very good question. I think productivity is really problematic, and I didn't touch on it too much, but if you look at the GDP per hour work, which is the output for the amount of hours that we're working, it's back down at about levels we haven't seen since 2018. So our workforce is not as productive as it needs to be. And I think in the housing construction sector, you can really see that. I've worked in the industry for 20 years, and houses have basically taken 4 to 6 months to build right throughout that period of time. There's never been any improvement in productivity. We definitely need to improve productivity. Now, businesses are investing a lot at the moment in CapEx. CapEx spending is right up. We've also taken on a lot of new employees during the pandemic, and it does take time to train them up. So we should start to see a little bit of an improvement in productivity, but there's a lot more that needs to be done, and we need to look at tax settings and other things to really improve our productivity performance here in Australia. The second question was, at a micro level, you mentioned that you believe the Victorian house prices will increase at a slightly higher clip this year than last year, but that also there are more listings than ever and buyers of greater bargaining power. Where then will that predicted price growth come from? I think what it's going to come from is basically the tax cuts that we get in the middle of this year. The modelling suggests that's the equivalent of about 3 to 4 interest rate cuts. And I think that will start to see more people coming into the market. Plus also, as we get closer to the end of the year, we'll be getting closer to those interest rate cuts early next year, and we might start to see more and more people wanting to set themselves up to purchase that property late this year in anticipation of those interest rate cuts next year. There's a few other questions that I'm going to try and answer for you. They're these questions. So if anyone has any further questions, please type them in quickly now. Might give you a minute or so, but if not, we might end the webinar there. But I'd really like to thank you all for coming today. I've got a question from Charlotte Hall. Do you still see much exiting of investors and residential renter providers in 2024? So we are still seeing about 33% of new listings at the moment are still investor listings. And I wouldn't be surprised if the fact that it's now looking like interest rate cuts are going to be later, that might actually tick up a little bit more over the next few months. And so obviously that's bad news for the rental market. It's going to exacerbate some of the challenges. So we are still seeing quite a high number of investors exiting the market, unfortunately. Now, that's partly tax settings, but that's also partly just financially, that people have been trying to hold on to these properties for a couple of years. As interest rates have gone up, they thought interest rates were going to get cut at the end of this year. Now it's looking like next year, and some people might just be in this situation whereby they're going, I just can't hold on any longer. Got another question from Bill Branthwaite. The 1990s took a long time to recover. Is there any reason why this period should be more rapid? Look, I think there's obviously a lot of trouble, the state debt and things like that in Victoria at the moment. I think that the reason why I think the recovery might be a little bit more rapid is that relative affordability of Victoria that I was talking about, but also we're probably going to be looking at interest rates being cut. Whereas you look at the early 1990s, obviously interest rates came down during the recession, but you were looking in Victoria, the recovery took a long time because it was during a period where interest rates were starting to rise again. I've got a question here. Have the land taxes and compliance requirements influenced the number of investor listings? I mean, anecdotally, definitely that's the case. We have seen a high level of investors exiting the market for most of the last 4 years, but I think those changes have certainly contributed to further increases. There's a question, will there be a similar webinar based more around the commercial property market? I'm not sure, but we can find out. I'm sure at some point we'll be looking to do that. You mentioned that 33% of investor listings is very high. What would the normal be? So we've only got that data back about 8 or 9 years. Historically, it's about 20-25%. So we are definitely seeing more investors selling out of the market than we have seen in the past. All right. Well, I'll thank you for your time. Hopefully this presentation was really beneficial for you, and I'll talk to you again soon. But thanks very much.